Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we're going to be analyzing Huntington Ingalls Industries stock. This one came in by request down in the comments section of one of my other videos. If you have a request, just put it down in the comments. I'll get the ticker on the whiteboard behind me. Usually, I reply once I actually get it written down on there and let you know that it's up on the list. And eventually I'll make a video for you. If it's a stock that's in the S&P 500, like Huntington is, I post those on YouTube for free. The rest I post over on Patreon. And at the $5 tier month level, you can look at all the analysis that are not in the S&P 500 and request some that you might want to see. I'll also have a 25% off affiliate link for Fast Graphs down in the description, which you'll see me using in this video. You see it in a lot of my videos. Pretty useful for analyzing stocks. As always, this is not individual investing advice. This is just how I analyze stocks. So Huntington Ingalls I've followed for quite a while. I almost bought this stock. I forget exactly when it was. It might have been back around 2021 when I bought Lockheed Martin. It looked pretty interesting, or it could have been during this big dip here too as well in 2020. But I decided to hold off on it because I thought the earnings growth, the more recent earnings growth, was just a little bit too slow for me. Now, if we go back, so about, like 80% of what I do is like quantitative, basically. It's about crunching the numbers to make sure that something like makes sense. Like the numbers need to make sense. But the parameters you use in order to get those numbers, you have to use, it's not always the same. You have to use some judgment. And at the end, you kind of always need to use some judgment too. And usually I get stricter the closer a stock gets to, if I get ready to buy it, then I kind of, usually using my most strict standards, if there's anything that kind of jumps out at me that I'm, not comfortable with or whatever. Sometimes that can prevent me from buying a stock that I've been following for a long time and had a buy price for a long time. Because first I make sure the numbers make sense, and then I go in with kind of more scrutiny and look at the numbers and then zoom out and look at the big picture sometimes. And there can be other reasons why I might just hold off buying a stock. And that's what happened with this one. I forget exactly the timing, but it was during one of these drawdowns that it had. So if we just look at, let's just go shorten this end time frame to this year. And then I'm just going to go back to, I think maybe these guys merged at this time. And that's why the data only goes back to 2012. So we have kind of a new business here. I don't know that for sure, but that's probably what happened. So we go back to 2012 and we take the time frame from 2012 to 2024. And this is just going to measure the earnings growth from this point. It's going to go from this point to this point, and then it just kind of assumes a straight line in between them, and calculates what that earnings growth rate would be, which is this dark green shaded area here. So they have 11.64% earnings growth from 2012, basically, or the end of 2011 to the end of 2024. Well, that's pretty good earnings growth. But if we look a little bit closer at the chart, we see the vast majority of that earnings growth came before 2016, which is actually quite a long time ago. 2016 is 8 years ago, and most of that earnings growth came in these kind of 4 years leading into 2016. So it's important to kind of keep an eye on things like that, because even though I use historical trends usually to try to extrapolate out to the future, there are certain situations where the recent trend is like important. Now, if it's a cyclical business, the recent trend usually isn't the most important. Usually it's the historical ups and downs, right? But if it's a more steady earning business, as a defense stock and company, and you see signs, especially if it's a bigger company. These guys aren't super big, but if it is a bigger company and they're well established, and you start to see these signs where revenue is slowing, where earnings growth is slowing, and it goes on for more than, say, like 3 years, and there isn't like an easy explanation for it, like there's a recession or something like that, or some specific thing with the business that some headwind that they hit, temporary downturn that's pretty easily identifiable that might rectify itself. Like if there isn't like an explanation for that, then usually I'm pretty cautious and I lean a little bit more toward the more recent data than the historical data. So if you were going to just look at the numbers, you would say, look, they are growing almost 12% a year. Now, what I do think is interesting is analysts think that they will grow like 12%. So these are analyst expectations here for next year at 12% earnings growth, and then 2026 at 15% earnings growth. And I will say that usually, because a lot of these have government contracts that are where the money comes from, like they come ahead of time, right? So analysts can usually do a pretty good job of like forecasting a couple years into the future with these, because they're like future contracts like that are gonna be fulfilled, right? So they might actually grow 12 or 15% the next couple years. I don't know, but it's worth kind of keeping that in mind, I would say, because I'm going to be a little bit more negative. So we can actually look at this analyst scorecard. They're right about, or they do better than them about 60% of the time. They're right on target about another 33%. So they really only miss them, we'll call it like 10% of the time in the past couple years, which is kind of what I'm saying. So it's definitely possible that over the next couple years, they could have faster earnings growth that maybe is more in line with this long-term historical rate than the rate recently. But me being conservative, so I want to put that context out there. But I am still, I'm going to show you where I'm at here. So if we take, this is 8 years, so it's not like a short time period. We have earnings growth during this time period of 1%, if you measure point to point. That doesn't include this downturn or this downturn. That just kind of takes a straight line from there to there. Although I bet if I did each individual year, which I probably did in my own analysis, it'd be pretty close to that. But they've also, these are earnings per share, and they've also bought back about 15% of their shares during this time. So that inflates this earnings growth number through this period because they've reduced the number of shares, which raises the earnings per share, which is what this is measuring. So earnings growth for 8 years has actually been lower. It's in between like 1% and 2% is what my estimates are. So let's take a look at that if I can get my spreadsheet to load here. Now, generally, even 4% would probably be about too low for what I'm looking for. So I have about 1.5% earnings growth expectation. And I want businesses that have a record of growing earnings faster than inflation. And so even 4% probably isn't really going to be enough for me personally, because one of the key benefits of owning a stock is that you don't if it's a high quality business that can pass costs on to their customers, you don't have to worry about inflation, right? Whereas if you have a bond, like a fixed rate bond, you do have to worry about inflation, because if the inflation rate is higher than the yield you're getting on the money you're lending out, then you're actually losing money, or sometimes just not making very much money in real terms. So for me, this is too low. Now, I will say their 3-year revenue growth looks pretty decent. So this is 3 years cumulatively, so maybe like 6 or 7% a year. So the revenue growth is, the last 3 years has been better kind of than this. So that's a positive sign to take in also to the positive analyst outlook of that kind of like 12%, 13% earnings growth rate the next couple years. So I don't want to be too negative on these guys and say, no, no way. But for the type of stocks I'm looking for, this just isn't quite there yet. And if we do run a valuation using this rate, it's below 5% 10-year earnings CAGR expectation. So that's pretty low. Now, I will also just for, so I want this number to be over 8%. The market is probably about 5.3 to 5.5%. So it's not too much worse than the market, but they really need to hit this earnings growth number. So I'm just going to punch 12 in here to see what it would look like if we did, if they do pull this off. Now this is a 10-year calculation, not just the 2 years that the market is looking forward to. So this assumes they can do 12% for the next decade, and that would give you a 6.79% 10-year earnings CAGR, which is about fair value, is what I would call it. So if you think this is going to happen, it's probably fairly valued, but I'm just not quite there yet. Now I'd be willing to change my mind, next year or whatever. So I still track this one on a regular basis. I come and revisit it. So if they did better next year and it looked like they were going to be able to keep that trend going, then I would update this, and you could see how that future expectation would adjust. But for right now, I think earnings growth is just a little bit too slow for me. And it's not even quite compelling enough to buy, even if I use kind of generous expectations. So I don't think I'm, in danger of like missing out too much over the medium long term right now. But I do keep tracking. I will keep tracking it. Oh, and somebody told me to move my face down so they could see the the title bar up here. I haven't changed these for a while, so hopefully they make sense. I can go over them. So this says when these were last updated. I actually just updated this one today, so I can change that to 9/30/24. And then this is the type of strategy. So this is a full cycle strategy. I have multiple strategies. This is like an earnings and earnings growth based strategy that you see me talk about on the channel all the time. This is like an earnings based CAGR. So these titles can mean different things depending on what strategy I'm talking about. So if I'm using the full cycle strategy, that will refer to different metrics than if I'm using a different strategy potentially. And then for some strategies, the things are just blank. So sometimes if I make a video like I'm doing now, I might put a link here if members of the Cyclical Investors Club want to, watch it later. Or if I write an article, I'll put those links here, and then I have little notes here for myself or for whoever. Sometimes they're for myself to remind myself what I was thinking, because I track like over 600 stocks. I'm getting close to 700 now. So I need to leave myself notes so that I can remember. And then we have the current price here. I have momentum grades for certain strategies, certain stocks. And then this would be, that's a good question. Oh, earnings per share using my things. Then sometimes I have debt adjustments and things like that. So there's lots of different columns up here. But yeah, usually I put my face in front of all this. So if I don't, so you might not be able to see it. And then this was the 3-year revenue, cumulative revenue. So this is 3 years total. How much have they grown revenue over 3 years rather than per year? This is per year. This is per year. Okay. And then I have other things that show when I think something might be a buy or whatever. So hopefully that helps everybody. I did remember to move my face. And if you found this video useful, hit the like and subscribe buttons. Don't forget to check out Patreon. I have a free tier over there now. And I'm going to have a new $25 tier that's coming tomorrow, which I'm going to put a video out on explaining that for everybody and how that works. I'm pretty excited about it. So I will see everybody later.